This year it's unusually delayed announcement of Q2 results, largely due to the intervening festival holidays and the scheduling challenges that such holidays bring about. Nevertheless, I'm happy to report a very satisfactory outcome of the efforts that the company has taken in its various businesses during the Q2 of the current fiscal. The business conditions continue to remain challenging, and particularly so for capital goods industry and within that space, the infrastructure segment. Recognizing that the recovery is not going to be dramatic or rapid, the company has taken several initiatives to improve its efficiency parameters, its delivery capabilities, its skill, its relevance to the customer. These initiatives border on several areas such as operational excellence, digitalization and productivity enhancements, portfolio rationalization, capital efficiency improvements, etc. We do believe that all these initiatives will stand the company in good stead, not only during the current challenging times, but also in better times that we hope to encounter soon. Having said this, let's review how the company has performed on its various parameters in Q2. And before I get into the specifics, the usual disclaimer on forward-looking statements that will be made in the course of this presentation. The highlights of the performance of the company for Q2 is a growth in the order intake by about 11%. All these are in comparison to the Q2 numbers of the previous year. The order book has grown by 4%. Revenue has grown by 8% for the quarter. And the earnings before depreciation, interest and taxation has kept pace with the growth in revenue by growing by 8% as well, thereby protecting the margins. And the recurring profit after tax has smartly moved up by 41%. Starting from the order inflow and the consequent order book position, during the Q2, the company procured orders worth 311 billion rupees, a growth of 11% over the 282 billion rupees of Q2 of the previous year. The order wins of 311 billion rupees on top of the 297 billion that we won during Q1 of the current year takes the tally for the half year to 608 billion rupees, which is a 12% growth over the 542 billion of the previous half year. Much of the orders have come in from the infrastructure segment in the domestic markets and from the hydrocarbon verticals in the international market. The point to note is in Q2, while the international orders was lukewarm, the domestic orders improved smartly by 36%. This is not to conclude that the investment momentum has returned back to the economy, but the fact is ordering and decisions around awards are beginning to kick in the domestic market, and we hope that these would be sustained through the subsequent quarters as well. The composition of the order between domestic and international by and large has remained unchanged between the 2 years in question. We have 2/3 of the orders from domestic markets and 1/3 from international markets. The order book, which has grown by 4% as of 30th September 2016, is at 2518 billion rupees or 2,51,000 crores, which is higher over the order book as of 30th September of 2015 at 2426 billion rupees. The share of international orders in this order book is about 29%, very close to the 28% share in the previous year. And that reflects almost 730 billion rupees of orders to be executed from the international contracts. The order book collectively represents over 2 years trailing revenue of the company that the current clock indicates. Where did these orders come from? The 608 billion rupees worth of orders for the half year largely came from infrastructure sector. Half of the orders is from that sector. Hydrocarbon in break from the previous year has joined the party in the current year and have reported a 14% share of this pie. Services have services part of the business portfolio that we run have done well, and reflecting the revenues that they earn as orders for statistical reasons have a share of 18% of the order pie. Power at 5%, electrical at power at 4%, beg your pardon, electricals at 5%, and heavy engineering at 3% actually complete the pie. The consequent order book of 2518 billion rupees as of 30th September has nearly 74% from the infrastructure sector at 1867 billion rupees, hydrocarbon at 202 billion rupees, and power at 172 billion rupees are the next larger pieces in this order book to be executed. This in a way reflects where the investments today are happening in both the domestic economy and in the Middle Eastern region where we operate. Coming into the specific performance, the revenue from operations for Q2 at 250 billion rupees is up by 8%, and revenue from operations for the half year is at 468 billion rupees, which is recording a growth of 9% over the half year of the previous year. Of this 250 billion rupees for Q2 and 468 billion rupees for H1, we have 89 billion rupees coming in from international contracts, which represent a 20% growth over the Q2 revenues from international contracts of the previous year, and almost similar 19% growth in the H1. So the growth in the revenues is largely driven by the execution progress that we have achieved in the international contracts that are under execution. In contrast, the growth in revenues from domestic contracts still continue to be muted and face headwinds that require tackling at the ground level. The manufacturing, construction and operating expenses for the Q2 has grown by 9% at 164 billion rupees, and likewise percentage of 8 for the half year at 301 billion rupees. We have in the current Q2, taken in write-off of the unsold inventory of the shipyard, and that reflects an increase in the Q2 numbers of the manufacturing, construction and operating expenses. We've been fairly efficient with the finance cost. The cost has gone up by 11% at 13.43 billion rupees in Q2 and 26 billion rupees for the half year. The effective cost of borrowing remains at about 7.5% for the group as a whole, which is remarkable considering the conditions in which we operate. The staff costs are up by 3% for the quarter at 34 billion rupees and up by 6% at 68 billion rupees. The company has taken a lot of initiatives to right size the staffing in its various businesses. I did mention about the digitalization initiatives, the productivity enhancement initiatives. All of that boiled down to redundancy of roles, and hence we've been able to shed as a group close to 14,000 jobs over a period of 6 months, ending 30th September. The sales administration expenses have gone up by 6% at 14 billion rupees and has gone up by 11% at 30 billion rupees for the half year. The increase in sales and administration expenses is largely on account of the provisioning that is required to be made in compliance with the regulatory requirements in the financial services business and the provisioning for expected credit loss that Ind AS, the new accounting standards, have mandated for the parent company's businesses. The total operating expenses for the quarter at 227 billion rupees and for the half year at 426 billion rupees registers a growth of 8% over the expenses of corresponding period in the previous year. Since the growth in the operating expenses match that of revenues, the EBITDA margins have been stable at 9.2% for the quarter and up by 0.2% for the half year at 9%. The interest expenses, the depreciation and other income accounts for the rest of the profit charts, and you will find that the other income has moved up smartly by 50%, largely on account of treasury gains that the company was able to achieve in the quarter ended 30th September 2016. The profit hence from operations before exceptional items are up by 41% rupees at 10 billion rupees for the quarter and up by 43% at 16 billion rupees for the half year. As you might know, then the company had indeed announced that the company divested its stake in the insurance business through its subsidiary, L&T General Insurance, and we recorded in the books a gain of 4 billion rupees at quarterly level. And since we didn't have any such exceptional item in Q1 of the current year, the same numbers are carried over as exceptional gain for the half year as well. Consequently, the reported profit after tax is up by 84% at 14 billion rupees for the Q2 and up 71% at half year level at 20 billion rupees as compared to 11 billion of the previous year. Getting into the segment details, the company drives its business through the segments that are infrastructure, power, heavy engineering, electrical automation, hydrocarbon development projects, IT and technology services, financial services, and the residuary segment called others. Looking at the key parameters in each of these segments and starting with the infrastructure segment, which is the largest segment that we run, the net segment revenue for the Q2 is at 113 billion rupees, up by 6%, and for the half year at 203 billion rupees is up by 7%. Of this 113 billion rupees and 203 billion rupees, the share of international contracts which are generating revenue are 37.5 billion rupees for the quarter and 67 billion rupees for the half year. They are up by 17% and 18% respectively. The EBITDA margins for the quarter for the segment is at 7.1%, a decline of 2.2% for the quarter, and at 8%, a decline of 1.1% for the half year. It is important to recognize here that being the project company, and we have spoken about this aspect of our business before, that the quarterly margins are not indicative of what would be the yearly numbers. And we do expect that the margin profile will improve as we go on to the H2 of the current year, and more particularly the Q4 of the current year. The power segment revenues have done well. The jobs under execution both in India and in Bangladesh have progressed smoothly. There is a 30% growth in revenue of the power segment at 17.45 billion rupees for the quarter and at 34.67 billion rupees for the half year. The share of international is pretty significant, 4.69 billion out of 17 billion coming from the international jobs and 8 out of 34 coming from the international jobs for the half year. The EBITDA margins of this business at 3% for the quarter and 4.4% of the half year are indicative of the pricing conditions that are prevalent in the market. It is also equally important to know that while these represent the EPC margin, the margins that are made on manufacturing power equipments are reported as part of share of profits of the company in the joint venture. So the margins of the entire power business, the EPC business, gets reported in two places and accordingly gets divided in terms of reporting. The hydrocarbon segment has turned around. We've had a very difficult 5-6 quarters in the past. We find that the jobs that are currently under executions are moving on nicely. There's a 33% growth in the segment revenue for the Q2 at 24.94 billion rupees and by 16% for the half year at 46.29 billion rupees.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.